Right, introduction to the algorithm. This will be sort of if you've already gone through the first week. Basically, if you're completely brand new, then you'll start there. But if you know what forex is, then this is where you'll be starting. So welcome. So algorithm. What am I even going on about? Right, some of you might even know what I'm going on about, but it's best to just go through the entire course content. So the price delivery algorithm. So you need to think of it like this. Everything in the modern world is run through technology, which are run through algorithms. Your phone, applications on your phone, my computer, everything's run through algorithms, right? That's just the way the modern world works. So using common sense, it'd be logical to think that the markets also run the same way, right? Because they run online. So we have an understanding that the forex market runs on the price delivery algorithm. Now, an algorithm is a set of rules and syntax. I would like you to think of the markets now to be run by an algorithm. The two things this algorithm books off, and you need to note this down, is one, rebalancing inefficiencies. Number two, delivering to buy and sell side liquidity. The algorithm is set in place by smart money. So when you see people talk about smart money or the banks and blah blah blah. We're not talking about Barclays or HSBC or Santander. We're talking Bank of England, Federal Reserve. Do you know what I mean? These are the top players with money. The markets are manipulated by the ones that hold the country's money. Right? They are the ones that control the markets. If you think it is a market without manipulation, then you're just wrong. Right? A quick note before I move on. I trade on the New York time zone. Right, so all of my timings on my charts refer to the New York time zone. It would be beneficial if you changed it. So if you go to TradingView and the bottom right, you can click there and change your time to the New York time zone. Right, because this is the time zone that the algorithm books off. Right, so the algorithm runs off of time and price. Most traders, most unprofitable traders, only consider price. When there is an x-axis and a y-axis, you need to consider both time and price. Write this down. You must consider time. It is so crucial. You will understand why. I think I go on chapter 3, right, where we start to go into time. Very important. So let's dissect the two things the algorithm runs off. Rebalancing inefficiencies. You will come to learn the types of inefficiencies to look out for. Right, in chapter 2, we'll go over all the different types of inefficiencies. Just right now, you need to just note this down, right? There are certain points in the market where price becomes unbalanced. It has an unbalanced price range. And the algorithm is coded to seek these areas before continuing to the second thing the market books off. The second thing is obviously seeking buy side and sell side liquidity. Once price has rebalanced inefficiencies, it then seeks buy side and sell side liquidity. The liquidity we seek is below old lows and above old highs. That needs to be written down also. The most accurate are previous day highs and previous day lows, previous week highs and previous week lows. These are significant draws on liquidity. Okay. Now, when you go and look into the markets, maybe after this PowerPoint slide, I want you to look at a chart. If you're not completely brand new, right, I want you to look at a chart, and I want you to just look at price on any time frame and watch how it delivers. Watch how price goes into a range, we call it a retracement, delivers to an inefficiency. Maybe some of you already know what some inefficiencies are, and then goes for those draws on liquidity. It happens over and over and over again. It's all, if you boil it really simply, this is what the market books off: inefficiencies and liquidity. That is it. Obviously, it's not as simple as that, right? But if you were to boil it down into those two things, it would just be that, right? Let's go over a couple things. I'll show you now, actually. So this here is an inefficiency. This is what we call an order block. So price comes to it, rejects away to this old low, right? And what's it done after this old low? It's probably going to fill this inefficiency here. Price comes up, takes out this high, comes back down to fill this inefficiency. The market just books off of these two things. That's all it does. And time is fractal, right? So meaning what happens on the daily happens on the 4 hour, happens on the hourly, right? It's all the same, right? You need to start looking at your charts and have that in your mind, right? Obviously, right now you're not really gonna, if you're new, you're not gonna know what inefficiencies are or how to spot liquidity, but essentially, liquidity, right, is any high or any low. There is liquidity resting underneath or above it, right? So above this high, there is this, right? How would I change that? Buy side liquidity. Under every single high and low, there is liquidity, okay? And as I stated, the more significant draws on liquidity are daily and weekly highs and lows. So this was a significant draw on liquidity. The algorithm seeked out this, and you will get to see that after price takes out an opposing side of liquidity, right? So let's say if you're bullish, price takes out this low. You need counterparty liquidity to be induced before going into your intended bias. Now, I think I'm rambling on a bit, right? But that might be a little bit complicated for now, but just have that in the back of your mind also. Right, so see here, for example, price has taken this high, then we've retraced. Okay, there will probably be like a daily inefficiency here, right? Now, if our overall bias is bullish, this, and even this from this point, right? This is a weekly high, this is a weekly high, this is a weekly high. They're all highs that did not get taken the next week, right? So this is resting liquidity above each of these highs. So I want you to start thinking like that, right? That price moves as an algorithm.